Hello viewers, in this knowledge module, our main purpose is to understand what is Sharpe Optimal Portfolio and how we can obtain a portfolio whose Sharpe ratio is the highest. But for that purpose, first we have to understand the Sharpe ratio. So the learning objectives for today's lecture are what is Sharpe ratio, what is Sharpe optimal portfolio, and how to compute the weight of a portfolio of consisting of two assets whose Sharpe ratio is highest, and therefore it becomes a Sharpe optimal portfolio. So what is Sharpe ratio? This is the first thing which will come to in our mind. So the Sharpe ratio is a measure of a portfolio performance in which we consider the risk as well. So might be some investors are only looking at the raw return, but the raw return has limitations and it should not only be considered before for the purpose of the investment. Apart from the raw return, the main thing is to consider the risk as well. Might be one is investment is giving you a little bit of less return, but at the same time there is substantially low risk. But the other investment is giving you a little bit high return, but there is substantially higher risk over there. So the Sharpe ratio basically consider the risk adjusted return and not the raw return by itself. So the formula of the Sharpe ratio is the return of the portfolio minus the risk-free rate of return divided by the standard deviation or risk of the portfolio. So this is the overall risk. This is not the market risk. It's not beta. If it is beta, this is called a trainer ratio, but this is a Sharpe ratio. So it means that this numerator is considered, we call it the excess return. That what is the return on top of risk-free return the investor is getting by investing into this risky portfolio. So it means it's a risk premium. So the numerator is the excess return divided by the portfolio risk. In other words, the Sharpe ratio is giving you that what reward investor is getting for bearing 1 unit of the 1 unit of the overall risk. RP stands for the portfolio return, RF stands for the risk-free rate of return, and this is the standard deviation sigma of the portfolio return. WS means that percentage of the portfolio made up of asset S, like how much percent of the portfolio is in the asset S. So if there is a portfolio consisting of two assets and there is a asset X and total amount invested in the portfolio is 1,000, and if you have invested only $300 in X asset, which is a part of a portfolio, it means that the percentage of the portfolio in that X asset is 30%. So the weight in terms of decimal is 0.3. So now consider these two assets. Consider this portfolio consisting of two assets. One is of stock funds and the other is consisting of a bond fund. And the return on the stock is 12% expected return. Its standard deviation is 15%. The expected return on the bond fund is this is actually the stock and a bond funds, right? Not funds, fund and the bond fund. So the expected return on the bond fund is 6% and its standard deviation is 10%, and the correlation between the return of these two funds is 0.1. We know that the expected return of the portfolio is simply the weighted average of the expected returns of both assets or all the assets present inside the portfolio. Over here we have two assets, so we are writing over here that it is the expected return of the it is the weighted average of the expected return of the individual assets. So asset 1 is it's a bond fund, and the asset 2 is the bond fund. The first one is the stock fund, sorry, asset 1. So we can compute the expected return based on that, and at the same time the standard deviation or the risk of the portfolio is given with this formula. If you take the square root of this expression, where you have the sum of the square of weight of the stock fund multiply by its standard deviation square, this is variance, the square of the standard deviation, plus the weight of the bond fund, and multiply by the variance of the bond fund, plus 2 into the weight in the first asset into the weight of the second asset into the correlation of the return of the both the return of both the assets and the standard deviation of the return of both assets. This will give us the standard deviation. I've computed the expected return of the portfolio and standard deviation of the portfolio in an Excel file over here. Sorry, yes, this is the Excel file. Sorry, this one. And if you see, I simply kept changing the weights with the 5%. So over here, I'm considering that everything is invested in the stock and nothing is invested in the bond fund. And then I reduced the weight by 5% in the stock and gave it to the bond fund. Obviously, whatever is not invested in the stock, it is invested in the bond. Likewise, with the 5% difference, I consider all these different portfolio weights until there is nothing invested in the stock funds and everything is invested in the bond funds. And I calculated the expected return. You can see over here, it's the weighted average. So A5 into C3, A5 is actually the weight in stock multiplied by the C3, which is actually the expected return of the stock fund, plus B5 means the whatever weight is pertaining to the bond invested in the bond. Over here it's actually 10%, 0.1 into C23. So C23 is the expected return of the bond. So I computed the expected return of the portfolio. So this is the expected return of the portfolio. This C column is giving you expected return of the portfolio, right? And then this E column is giving you the standard deviation of the portfolio. And how I computed it? I computed it with this formula. So I use this formula over here. You can see that this long formula. So I took the square root, and then inside that it's basically sum of 3 terms, where the first term is the square of the weights into the standard deviation, into the square of the standard deviation of, or in other words, variance of the stock, plus the square of the weight of bond weight multiplied by the variance of the bond fund, plus 2 into the weight of both assets into the correlation multiplied by the standard deviation of the both assets. So return of the both assets. So this is how I found the expected this is how I found out the standard deviation based on different weights. So this E column is giving you the standard deviation, right? And finally, I calculated the Sharpe ratio. Over here, remember, while doing this, the correlation which we have considered is 0.1, and risk-free rate we need in order to find the Sharpe ratio. So the numerator is actually the excess return. So whatever is the expected return of the portfolio, you have to subtract the risk-free rate from it. So this will give you the excess return in the numerator. Remember, RF over here, this thing, the portfolio return is from the portfolio return, we have to subtract the risk-free rate of return in order to get the excess return. So this is how we are getting the excess return. So this I'm only calculating the numerator in the column D. So 11.7% minus 4%, 7.7%, then 7.4% minus 4%, sorry, 11.4% minus 4%, it is giving us 7.4%. So this all like orange like column, in fact the column D is giving us the excess return, and once we divide it with the risk, which is the standard deviation of the portfolio, with these given rates or whatever given rates are over there, we'll be able to find the Sharpe ratio. So this is how we will get the Sharpe ratio, and I plotted the Sharpe ratio. Sorry, I plotted the expected return. It's not the excess return, it's only the expected return versus on the x-axis the standard deviation versus the risk. So this is the curve I am getting. This is anything below this line, we get. So this I have reproduced over here in my OneNote. This thing, can you see that? So anything below this line, below this, like over here, you should not invest. Because why you should not invest? Because this is inefficient portfolios. At the given risk, you have another portfolio present with the higher return. So something like over here. Then why with the same risk level you wanted to get this much return? So these are not desirable at all, right? So you want to invest in the portfolio which are on somewhere on this line, because for the given risk level we have the highest return lying over here, right? But the thing is this, that there is only one portfolio through which we will be able to get the maximum Sharpe ratio, and that portfolio is called the Sharpe-Optimal portfolio. And look over here, this over here. So what is this A? This A is actually giving us the slope of this line A. So if you invest in this portfolio A, this is on the line, but this is an inefficient portfolio, and it will be giving us a Sharpe ratio, which is actually the return over here, somewhere over here, minus this risk-free rate of return, which is 4%, divided by the risk over here, right, on this line, right? So what is this? The slope of this line, which is going through the portfolio A, is giving us a Sharpe ratio, right? Because if you see over here, this is the formula. This is the formula. So this is actually our numerator, return of the portfolio minus risk-free rate of return. So return of the portfolio over here, this one, this A1. So I reproduced this set over here in another picture. So this is the portfolio A, and this is giving us a return near about somewhere between 6 to 7%, right? I'm not able to draw the clear line over here, but 6 to 7%, right? So what is the excess return? It's actually whatever is the return you are getting minus the risk-free rate of return, which is 4%, right? So this is over rise. Like in order to get the slope, it's rise over run, and run is basically over here on the x-axis, right? So this will give us the Sharpe ratio. In other words, the slope of this line over here, this one line, is actually the Sharpe ratio of portfolio A, right? So where we have a certain weights, a certain investment in stock funds and certain investment in the bond fund. Now look over here, this one. The aim over here is to get the portfolio and get such a weight or invest in such percentage in the bond funds and stock funds where this slope of this line should be maximum. And what should be that line? The line which is just tangent to this investment opportunity curve or investment opportunity set. So it just touch and goes away. So it means over here we have the steepest slope. The steepest slope will give us the sharp optimal portfolio, which will be having the maximum value of the Sharpe ratio. And this is what we want. It means that for the given 1 unit of the risk, you are actually getting rewarded with the highest. You are getting the highest reward because the numerator is maximum over here, right? So this is actually the purpose. If we eyeball, I calculated the Sharpe ratio in the Excel. If you eyeball, you will see that the maximum value, if you can compute it up till the 3 decimal places, is this one, 0.553. So in order to get a portfolio with the Sharpe ratio of 0.553, in other words, it's a Sharpe optimal portfolio, you need to invest 70% in the stock funds and 30% in the bond funds, right? And this, in order to get like this weight, there is another way we can do it in Excel, and we can use the tool which is called the solver tool from the Excel. And in order to enable the solver tool, you need to first go into the options, right? And in the options you have add-ins, right? In add-ins you have to press the go button. In my case, it's already added. If it is not added and it's inactive, so check this solver add-in and press OK. And then when you will go into the data tab, it should appear over here. Now, what did I do? I put the expected return of the stock funds and bond funds, and the standard deviation of the stock funds and bond funds, and you can see that these are the values which I just fed into the cells, right? So they are not calculated from somewhere. These are the values I'm giving, and this is the risk. So this is again I fed this value in the Excel. Likewise, the correlation I fed. However, when it comes to the expected return, I have to put the formula. So the formula is, you can see that it's F17. So F17 is over here, the stock weight. Remember what was the formula of the expected return? It's the weighted average of the expected returns of the individual assets present in the portfolio. So it means weight of each of the asset, that how much percentage of the portfolio you have invested in that asset, multiply the expected return of that asset, right? So F17, right now it's blank, but there is a reason why it's blank. I'll explain you and you will understand once the video will finish. So from this cell we are multiplying. So I intend to have the weight of the stock over here. So the weight of the stock, which is F17 over here, multiply by the C4. This is C4 plus F18, the weight of the bond, right? Multiply by the C5, the expected return of the bond fund. Now, in case of my standard deviation, it's simply the square root of the formula. This formula, square root of this thing over here. We have the formula. For some reason, it's not opening. Yeah, this one, square root of this term, right? Whole term, right? So this formula, the whole formula, I used over here, right? So F17 into F17, which is the square of the weight of the bond funds, multiply by the C9, which is the standard deviation of these bond funds over here, right? Likewise, the F18, which is the weight of the square of the weights of the bond funds, multiplied by the C10, which is actually the variance or the square of the standard deviation of the bond funds, plus 2 into C9 and C10. What is C9 and C10? We know these are the standard deviation, multiplied by F17, F18, which is the weight of the bond fund and the stock fund in the portfolio, multiplied by C14, which is the correlation. So this is over here. And then over here, we have to write the formula for the Sharpe ratio. The Sharpe ratio is simply F4, which is this one, the expected return, minus C12. So C12 is the risk-free rate of return divided by the F6. What is F6? So F6 is our standard deviation, this one, which I computed with the formula. Now, with the solver tool, this is my target cell. With the solver tool, this is my target cell, sorry, the Sharpe ratio one. The solver tool, I'm asking the solver tool that keep changing the weights over here in such a way that this Sharpe ratio should be maximum, right? So look over here, what I'm doing. I'm clicking this Sharpe ratio cell where I have used this formula of the excess return, right? The expected portfolio return minus the risk-free rate of return divided by the standard deviation of the portfolio. And I am asking the solver button to give me the maximum value in F10. Can you see that? This F10. So this F10. And it should give me the maximum value. And I'm telling the solver tool to keep changing F17. This one. Keep changing it. And keep changing it in such a way that I end up getting the maximum value over here in F10, which should be the Sharpe ratio. And then I also added constraints. So if you want to add later on, you can add any constraints over here, right? I have already added, so I am not putting it. So I'm adding the constraint. I'm saying that F17 should be greater than or equal to 0, and F18, which is the weight of the portfolio weight of the bond fund, should be greater than and equal to 0 as well, right? And then I'm solving it, and you can see that as soon as I click solve, the weights will appear over here for both the funds, and those weights are the weights. If we invest in that percentage, we'll get the Sharpe-Optimal portfolio with the maximum or largest Sharpe ratio. And you will see that this Sharpe ratio will be the same which I have shown you earlier. So solve, and it has already solved it, and I'm getting the Sharpe ratio of 0.553, and it is telling me, the solver is telling me, that if I invest 70% with this data set of the expected return and the standard deviation of the individual assets like stock funds and the bond funds, if I invest 70% in the in the stock funds, and rest 30%, 1 minus 100% minus 70%. So in decimal, it becomes 0.3. If I invest 30% in bond funds, so I will get the Sharpe ratio of 0.553. So this will, with this portfolio weight, I'll be able to have a Sharpe-Optimal portfolio. And this is the same number with 70% and 30%, which I have shown you earlier. If you remember this one, 70% in the stock funds, 30% in the bond fund, and 0.553 over here. This concludes my lecture on the Sharpe-Optimal portfolio, and I hope that you are able to understand this concept in a fine way and in a better way. Thank you.